Now, once you have understood the time value and the intrinsic value of an option, the next question which would come to your mind, or rather should come to your mind, is that when and how an option will start earning money for you. Now, before we answer this question, there are certain things which we must know. The first thing is that the premium for the option does not remain constant. Whether it is a call option or a put option, the premium will not remain constant throughout the expiry cycle. Depending upon circumstances in the market, the premium will keep changing. It will either increase or decrease. Now, factors like time decay, fall in the asset price, negative news, negative sentiments, all these things will bring down the premium. For example, let us say that you have purchased a call option at a strike price of 330 by paying a premium of $26.6 or rupees, whatever. All right. Now, let us say nothing is happening in the market. There is no price movement of the underlying asset. Everything is quiet. But as the number of days keep passing and the number of days for expiry keep reducing, the premium will start coming down because of the time decay. The time value will keep reducing. So the premium will start coming down from 26.6 to 25, 24 and things like that. Similarly, some negative news or negative sentiments in the market, all these things will affect the premium price. And factors like increase in the asset price, some positive news, positive sentiments, these are likely to increase the premium. Again, for example, you have bought the call option at the strike price of 330 when the spot price was 337. Now, suppose the price of the underlying asset increases from 337 to, let's say, it increases to 350. So, obviously, the premium here will also increase. And the change in premium is not uniform across the chain. The premium will change, all right, but it will not change uniformly across the chain. For example, let us say you have purchased a call option at 310 by paying a premium of 40.1, all right, when the strike price was 335 or 37, whatever. Now let us say that the price has increased to 350. The price of the underlying asset has increased to 350. All right. So let us say there is an increase of 15 rupees in the price of the underlying asset. So here for those call options which are in the money, for example, this 40.1, this premium may increase by 15 rupees. All right. At the money, now this 350 will become at the money. If the price has increased of the asset to 350, this will become at the money. So this premium will also increase, but it may not increase by 15 rupees. It may increase by little lesser, maybe say 12 rupees, 11 rupees or 13 rupees, whatever. And for this which is at the far end, say 370, the strike price 370, here the premium again will not increase by the same amount, 15 rupees. Here it may increase by a lesser amount, maybe say 8 rupees, 7 rupees, whatever. All right. So across the chain, the increase or decrease in premium will not be the same. And another thing which you must remember is that there is no contact between the buyer and the seller. Often during my lectures, I keep saying that the buyer of the option will run to the seller and tell him so and so, or the buyer will walk up to the seller and tell him, now you pay me the difference. No, it doesn't happen like that. That was only for the purpose of explanation. There is actually no contact between the buyer and the seller. Everything is through the exchange. If you are entitled to some money, that money will automatically come into your bank account. And if you have to pay some money, that money will go from your bank account. You don't come into contact with each other. The buyer and the seller do not come in contact. All right. And then we need to understand the concept of margin money. Now you see, a buyer of the call option just pays the premium and he is a free bird. He does not have any liability. Alright, he can just walk away if he does not want to exercise the option. He is a free bird. But what about the option seller? The seller bears unlimited losses if at all the losses happen. So what is the guarantee that the seller will pay up the losses? So a seller of the option, whether it is a call option or a put option, the seller of the option will always have to pay some margin money to the broker. That money remains blocked. And should he sustain any losses, that losses will be deducted from the margin and he will have to replenish that margin. About the margin money, we have adequately discussed in my other course, which is about the futures. But not to worry, not required to know in so much of detail. Just remember that the seller of the option has to keep aside margin money, which would range somewhere in the range of 10 to 15% of the contract value. And then there are certain things called as option Greeks. We should know about them. We will talk about the option Greeks as we progress through the course. At the moment, it is not required. Now, if you have understood these considerations, then two questions will arise. All right. Whether you are hedging or you are trading. If you are into the business of stock options or if you are indulging in stock options, you may either be doing that for the purpose of hedging your portfolio, or you may be wanting to generate some income by trading in options. All right. Hedging is an important thing. As I said earlier, the options are primarily designed for the purpose of hedging. So we will discuss hedging little later towards the end of the course. Right now, we shall talk about trading. All right. So if you are trading, then there can be two broad situations or two broad strategies. Situation one is that you are trading an option. You take a trade position in an option, either you buy an option or you sell an option, maybe call option or put option, whatever, and then you wait till the expiry to see the result of profit and loss. All right. In that scenario, your profit or your loss will depend upon whether the quantum and the direction of the asset's price, this is the asset Tata Motors, that asset price movement has been as per your perception or against your perception. That means whether the price movement has been favorable to you or not favorable to you. To understand with an example, let us consider that you have purchased a call option at the strike price of say 350 rupees, all right, by paying a premium of 17.35 dollars or rupees, whatever. All right. So the strike price is 350, and when you purchased, the spot price was 337 and the expiry date is 29th July 2021. Now what can happen is the price of this underlying asset can change. It can increase or decrease, and at the time of expiry on 29th July, let us say that the price of the underlying asset is 350. All right. You have purchased a call option with a strike price of 350 and the price of the asset also comes to 350 at the time of expiry. Now, would you want to exercise that option? Obviously not. You would prefer to lose this premium amount which you have paid and your option will expire. You are not gaining anything. You are not earning any profit. You will earn a profit only if the price of the underlying asset goes beyond 350. And how much beyond 350? See, you have paid 17 rupees 35 paise as a premium. So it should go 350 plus 17.35. That means 367.35. If it goes beyond that, then you will start earning profit. If it remains below 350, then you are losing your premium. All right. But suppose it comes to 355. In that case, what happens? In that case, you get back something. Since it has become more than the strike price, say 355, so 5 rupees you get back from the seller of the option. 17.35 minus 5, that is 12.35 he will retain. 5 he has to give back to you. So just understand it broadly. We will discuss about it in more detail subsequently. And the second situation could be that you trade in an option, you buy or sell an option, and then you want to exit before expiry, anytime before expiry. In such circumstances, your profit or your loss will depend upon whether the change in the premium is favorable to you or not. Again, let us consider an example. Say you have bought a call option at the strike price of 330 by paying a premium of 26.6. And after some days, let us say the price of the underlying asset, that is from 337, it increases to say 360. All right. So obviously the premiums will also increase. Let us say the premium from 25 or whatever 26.6 you had paid, now the premium has become, let us say, 50 rupees. So you are in a profit. You can square off, and the difference between that premium you have bought, while buying you had paid a premium of 26.6, now you are selling at a premium of 50. So the difference multiplied by the lot size, that much is your profit. On the other hand, if the price of the asset has gone down, the premium would have gone down. Let us say the premium has come down from 26.6 to maybe say 20 rupees. In that case, you are in a loss of 6 rupees 60 paisa. If you feel that you cannot sustain a loss more than this, then probably you may have to exit with a loss of 6.6 multiplied by this lot size. That much will be your loss. So just try and understand this. In detail, we shall discuss both these situations in the subsequent lessons. All right.